Chris, can you hear me?
I can now, yes.
Okay. All right. I'm gonna try and start this one. Let's see. All right. It looks like we're recording, so I believe we're live. If you can't hear us, please use the chat box. I'll go ahead and monitor that, but we'll go ahead and get started here. Good afternoon, and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. I'm Amanda Sylvia, and I'm the Client Service Associate for SCM. I'm so happy to be assisting Chris today. I do want to start off with just a few housekeeping items. On your GoToMeeting taskbar, you should see a section specific to questions. We hope that you feel comfortable to use this section to submit any questions that you may have. And I will go ahead and ask Chris to answer as many as he can at the end of the webinar. If we do happen to run low on time and we do not get to your question, Chris or myself will reach out to you at the end of the webinar to make sure we can get your questions answered. I'm so excited to introduce our speaker, Chris Gauthier, Stonehearth's Chief Investment Officer. He brings more than 20 years of investment management experience to our firm. He's been with our firm for 10 years. He's worked with both institutional and individual investors, and he's responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda, and good afternoon, everyone. Thank you for joining me on this wet, foggy New England fall day here. Good day to be inside in front of the computer, going through some economic data. So, looking at the market right now, we're definitely living in interesting times. In fact, this is probably the most interesting time period in my career. And that's saying a lot. I was actually investing during the great financial crisis. So, it's definitely interesting. And we got a lot to go over today. So why don't we jump right in? And what we're going to cover today, we're going to review recent financial market performance, and it has not been pretty, as most of you are aware. There's been nowhere to run and really nowhere to hide lately. Then we're going to take a look at the current investment environment from a macro and financial market perspective, which surprisingly, given the poor performance of financial markets and almost record levels of negative investor sentiment, it's not all bad. Now, I'm not saying it's a great time to take on risk, as we still remain defensive in our asset allocation, but there are a few bright spots, and we'll take a look at those. Then finally, we'll look at how we're positioning client portfolios in this environment. And like Amanda said, we'll leave a few minutes to answer any questions you may have. So I always like to start with the framework for this presentation with our investment philosophy. And this is something we've cultivated at Stonehearth over the years. And I think it really matters, especially when you're looking at investment companies, financial advisors. They should have some base investment philosophy that they base their investment decisions on. And we have investment philosophy here, based on mean reversion, right? Trees don't grow to the sky. We big believers in valuation drive long-term returns. We do believe in core factors, and the benefit they can provide client portfolios. Diversification, it doesn't work all the time, but it's still really the only free lunch in investing. And finally, really, risk is not stationary. We've seen that throughout market cycles, but really fluctuates and must be accounted for in portfolios. So as we started off, let's start with historical performance of asset classes. And like we started off, there really was nowhere to run, nowhere to hide. I'm looking at the asset classes here, from the previous presentations. Hopefully you remember that purple's fixed income, so think bonds, blue, US equity, green, overseas, international, including EM, and yellow is pretty much any asset class that doesn't fit into the above three categories. So you can see, the dollar was really the only asset you see on the left-hand side, on the plus side in the third quarter. And as you would expect in a poor equity tape, rising rates, credit, at the short end, think about short-term treasuries, some floating rate, some more higher yield, held up the best. Downside in fixed income land, again, that's in purple, really led by duration. And that was represented here by those long-term treasuries down a little bit over 10%. Looking at equities, no love there either. More volatile equity space. The NASDAQ, which is really just a proxy for the FMAGA stocks, like Apple, Google, Amazon, held up best, but it's still down 5%. U.S. equity in blue really continues to outperform overseas by a wide margin. You can see S&P is a proxy for the U.S. equity market, down a little bit under 5% in the quarter. And you start looking overseas, and it's almost double that. International developed, think Europe, down over 10%, EM even worse at 13. It's tough with the overseas assets right now. They're dealing with a prolonged war on their border, political, Great Britain had a prime minister the last 44 days, energy crisis, again, due to that war, but, the winter's coming up, and along with this, just continued defiance from China on all fronts. Really tough to get excited about international markets right now. As I said, there are some bright spots, and decline in oil over there on the right, down almost 20% in the quarter, is one of them for consumers, especially anybody who fills up their tank. Really did have a huge run up, but at least we're starting to see some relief at the pump, as it was the worst performing asset in the quarter. Taking a step back, ugly quarter all around for sure. It doesn't get much better when we extend the time frame to a year. A few places to hide, but not many. Looking at the same asset classes, just doing a year-over-year performance number. Still see oil, but this time we see it up on the left-hand side on a year-over-year basis and leads the way. Even with its recent decline we saw. The dollar's still there. Up almost 20% over the past year. And commodities, which again, obviously by the name, has a big slug of oil baked into it, was also positive. Other than that, not much to like. Again, like we saw in the quarter, short end of the curve. I think short-term treasuries, floating rate again, providing the best downside protection. But, it is still relative. They're still down 5%, but just providing some better protection. Gold held up as well on a relative basis. In equity land, we continue to see the U.S. leading the way. Again, to me, it's just more they seem to be the best house on a bad street, But they were still down. If you look at the S&P as a proxy, down double digits, almost 15.5% year over year. As we saw, EM brings up the rear again. China, stronger dollar, really weighing heavily on that asset class. In fixed income land, duration continues to be the laggard, but it was ugly across the board as fixed income was bad. How bad? Well, pretty bad, as you can see in the next chart when we compare the current bond performance to history. And what we're looking at here is historical performance of the Bloomberg. Used to be Barclays. I'm old, so I still call it the Lehman aggregate. But it's like the S&P 500 of the bond world. It kind of gives you the big picture view of how bonds are performing. Data goes back to 1976 when the index was incepted, and you can see every year the path of the bond market. And you can see that big call out down the bottom, that blue line. That's where we are currently now. And you can see there's nothing even close to that. You don't have to look at all those squiggly lines, but that's what the bonds have done before. You can just see how massively underperforming the bond market is this year, not just in performance, but compared to history. It's been a worst bond performance index has ever experienced, by a wide margin. And it's not just having impact in bond land, it's having really an impact throughout financial markets, as can be seen on the next chart. Now, when we look at the historical returns of a 60-40 portfolio, going back to before the Great Depression. So this time, instead of that aggregate, which only goes back to 1976, we're using treasuries as the fixed income proxy to capture that greater time frame. You can see that at a 19.3% negative return, this is as of 9/23, but it's pretty similar to the end of the quarter, we have experienced the worst returns since the Great Depression of the 30s when 60-40 portfolios were down 27 and 20. Now, this is not to scare you or anything like that, or to get you too negative. It's just, the difference is the magnitude of the losses from before, right? Supposedly less volatile fixed income markets. We've experienced equity vol like we've seen this year, but we have not just seen it in conjunction with fixed income. So I think this goes a long way in explaining really the record level of negative sentiment investors are feeling, and sometimes they look at their portfolio and say, we've never experienced this before. Well, you haven't, right? Unless you were alive in the 30s or investing in the 30s, which I'm not sure many of us on this call have. To me, it's all about the Fed, as they unleash one big, large monetary experiment on a global economy. and not understanding all the knock-on effects it's going to have. And that's what we're investing and living through right now. So speaking of the Fed, I'm going to show you the chart that continues to be the most important data point out there. I'm sorry, I skipped one. There we go. Well, data point out there is having the most influence on asset prices across the board, and really don't expect this dynamic to change anytime soon. We're looking at the Fed funds rate, right? It's in the news constantly. It's the Fed raising 75, 50. This is what they're influencing. They don't influence high yield rates. They don't influence long-term treasury rates, but they set that short end of the curve, that short-term Fed funds rate. And we can see right here from that dark lines going back to 00, we've been here before, right? We've been up at 6, we've been up at 5. And currently right now, when we look at chart right here, we're at 3.13, right? So that's where we are right now. And pretty much it's because the Fed has a range. It's range between 3 and 3.25. So that 313 is right in the middle. They always give a range. And what we can see with this blue line is where they expect rates to be going forward. So go for 3.13 to 4.4, 4.6. So again, onward and upward for the Fed. No surprises here. The big thing from this chart I want to take away is this dislocation between what the Fed said it's going to do in the blue line and the green line right here. This is what investors think the Fed's going to do. You know, they're starting to price in a little bit of a dovish pivot as of month end. You know, this is as of 9:30. So investors move closer to the Fed expectations in October. So I think that's a little bit of the weak performance we saw in the beginning of October was really having the investors come back to the Fed. And we look at the more current data, we can see when we're looking at market expectations for the Fed, looking at the different time periods. So the left bar is 11.2. So if we're at 3, 3.2, and expecting 3.7, that's a 75 basis point rate hike baked in. And that's about 100% chance, right? I mean, I just don't see the Fed moving off that 75. Then they have another meeting in December, and that's looking like another 75, 50, depending on when you look at. But again, the Fed and investors are now the same expectations. And when we meet the same expectations and they're not surprised by the data, you get better markets, which we're kind of seeing now, right? You have the past few days here. And you can see up to 4.4, 4.5. So again, you know, we don't see really a dovish pivot. And these are the market expectations, you know, for a long time here, almost into the end of 2023. So again, what's the Fed going to do? When are they going to stop? When are they going to the Fed dovish pivot, right? They say data, right? And all the time you hear it, they're talking about the data, the data. What data? Well, they're talking about inflation, and that's what they're watching. And we've seen through historical tightening cycles, which we're looking at here now, the first one being in 1974 and the last in 2018, that blue line is where the Fed funds actually ended, right? So that's when they stopped tightening. They didn't have to loosen after that. They just stopped tightening compared to the CPI. And you can see when you look for the Fed tightening cycles throughout history, they've always ended with the risk-free rate, that's the Fed funds rate, the blue line, above inflation. And we look where we are today on the right-hand side, we have inflation at 8.3 and the Fed funds rate around 3.3. We're not close, not even the ballpark. But as we'll see, there are some beginning signs that, you know, we might get there and maybe a little bit sooner than we expect. Chart implies we don't need to see inflation back at that 2% level. In fact, remember they talked about average inflation. They never gave the time period to give them a lot of wiggle room. But we don't need to see 2% for a pivot based on historical data because we just need to see Fed funds above the inflation rate. And that's when the Fed tends to stop. And again, it doesn't mean they have to lower rates, it just means they stop raising rates, which would be good for the markets. And also the inflation and with expectations we saw in the previous chart of the Fed funds rate, 4.5 to 5% by 2023, we would need to see inflation at or below that level. So let's see what's happening on the inflation front. Doesn't look promising, right? We look here on that light blue line, that's the headline CPI, that includes everything. Then we have that core one, which is the darker one, which excludes food and energy because they tend to be more volatile. But again, 8% doesn't look like it's anywhere close. But the chart does show some promise, you know, and we may have reached peak inflation and we may be headed lower from here. You can see that as a little dip at the end there on that chart where it has come down. So we're always reading about we're at high inflation. Yes, we're at high, but it is coming down. It may be trending in the right direction and a little bit faster than we expect. Yes, we saw a little bit jump in core CPI, but that's a lot of noise, not a lot. In general, you can see that at least it's coming down from its recent highs. So we're seeing improvement. We may not be seeing low inflation, but we're seeing improving inflation numbers. And it may improve faster than we expect. And I'd like to look at this chart on the left. And basically it's breaking out the CPI, which is what we just looked at and what the Fed kind of defines inflation as, through its individual components. And you can see over here in dark shades here, you have shelter, restaurants. That's what we consider sticky, right? Now, house prices don't move fast. They move big, but they move slow, and it takes a long time for them to kind of account for inflation and even deflation. What really moves is that less sticky means the energy, new and used vehicles. That's kind of like you think about the low-hanging fruit the Fed could pick very quickly by raising rates, decreasing demand, and you start to see a path to a 4 or 5 handle, given where the sticky is, which may take a lot longer, and the more volatile, less sticky, that could move a much quicker. So not in our base case, this lower inflation, but must be accounted for in portfolios, as it might lead to rallies in financial markets, which we want portfolios to be able to participate in, at least some. On the right-hand side, we're looking at investor expectations of future inflation, and it shows investors believe in the Fed. They believe the Fed's going to do its job. They have a 5-year inflation break even of about 2%. So what they're saying, based on their market expectations, is that inflation is only going to be 2% on average, or 2% 5 years from now. So again, this is a chart I like to look at because this is where the real risk lies. And it's what happened in the 70s is that expectations number became unanchored, right? And then starts to affect consumer behavior. They pull back and they cause the Fed to raise rates faster and higher than investors expect. And we talked about expectations on those previous charts. They're equal now. If the Fed deviates from that, we could have some struggling in the markets. So again, if that deviation happens, that's definitely not good for the markets. So again, when we look at these things, it's always about expectations and what is priced in as well. So again, we saw in the previous chart the topping of inflation, which just might be the start of a downtrend. Not there yet, but we are seeing some bright spots. It's positive signs from the data. So let's look at some of this data that we're seeing that helps us kind of make the case for we could be seeing lower inflation in the near future. The first thing I'm looking at here is supply chains, right? They're improving across the board. And on the left-hand side, you can see delivery times. Again, I'm sure I don't have to rehash everything you read about the press about not being able to supply. I know people who go to stores, including myself, and you just can't find items out there. That was really that supply chain, right? There was a bottleneck, some kinks in the supply chain. On the left-hand side, you can see that's really improving and improving fast, right? It's not like it's a slow downward slope. It is tanking. So again, supply chains are improving. And on the right-hand side, the prices that go into making the goods are also improving and heading in the same direction. So again, seeing improvement on the supply chains, delivery times shorten, the prices that companies pay shorten, should reduce prices consumers pay. And you can see where you can start to see some lower inflation due to improving supply chains. Another you might not think about is the strong dollar. Right? So we saw the strong dollar in performance, and you can see that on the chart on the left-hand side, just a massive rise in the dollar. Again, always a good and a bad when we look at economic data, right? Strong dollar, not sure it's great for the economy, but what it does do, it does make imports cheaper, and we are a net importer. We have a trade balance of -4%. Well, stronger dollar, weaker foreign currency equates to cheaper goods being imported, which then translate to help drive down domestic prices. So as we see the dollar rise, there is a benefit, and then we get cheaper goods, and cheaper goods should translate into a lower inflation rate. Also helping the case is energy, right? We saw the big 20% down move, and on the right-hand side over here, you can see the big move down from 120 down to almost 80. I think it's like 87 today, is last I saw. It's part of that volatile, low-hanging fruit piece of the CPI, and it's starting to move in the right direction. So we're really starting to see, recent Fed actions as having the desired effect. They're lowering prices. We're seeing improvement. But what about the other side of the coin, right? And when we talk about economics and the data, there's always the other side, or cause and effect. And the other side of the coin in this case is the big R word, recession, right? Does the Fed do its job too well and drive the economy off the cliff? Like it just can't pull back in time. So let's take a look at the evidence around the recessionary column. And the first thing we're going to look at is the slope of the yield curve. And what the yield curve is just basically going at different time frames, what the U.S. government can borrow when it issues 3-month bills, 6-month bills, 1-month bills, 2-year notes, 5-year bonds, 7-year bonds, and so forth out to 30 years. So again, that's the yield curve. We'll take a look at that a little bit later in the presentation. And what happens is you expect in a normal functioning economy, the government has to pay more to borrow 10 years than it does 2, right? It makes sense. You're lending the money a longer time frame, more risk, inflation, you expect a higher rate. But what happens is when the economy is not functioning properly, you can see some inversions in the yield curve. And what we're looking at right now, which is the purple line, is the 10-2 inversion. So this has happened before in history about 4 or 5 times, and it has an 86% success rate of calling a recession. So once this yield curve inversion happens at the 10s and 2, 86% of the time, small data set, you have a recession within a year to a year and a half. So that's the first sign that maybe there's a recession in our future here. We also like to look at the 10s and 3s, and that's not a 3-year, that's a 3-month, still the same 10-year, and that has a 100% hit rate. So again, another way to confirm, are we heading to a recession? That's getting there, and that's that orange line, but not quite there yet. So looking at the data, the inversion yield curve, there's something wrong with the economy, and does this data point at least supports that we could be heading off a cliff. What is not supporting this cliff or recession scenario is economic data. And we'll start with the PMIs. PMIs show it definitely slowing. You can see the downward slope to the right for sure, but really not a contraction. And basically, we define a contraction any reading under 50. So you can see COVID inducing, you can see it really under 50. You can see it over here at 2016. So again, that's when we say we're in a contraction. And I like this data, and we look at services and manufacturing. Services a little bit stronger than manufacturing, which you would expect, given we're coming off the COVID. It's because it's forward-looking data. It's a diffusion index. It's calling up companies that purchasing managers saying, are you buying more, the same, or less than last quarter? Do you expect to hire more, the same, or as last quarter? So it's more forward-looking and gives you kind of an insight into where the economic activity is happening in a few months forward, not looking back. So looking forward, based on these surveys, you can see an economy that, while slowing, is looking like it's at least still expanding, and that's a good sign. Another thing supporting not recessionary call is the labor market. Providing good, strong support for economic growth. We need a record low unemployment at 3.7%, showing strong wage growth, which is that blue line, up at 6.1%. And we see all inflation coming down, right? So, if you look closely, those lines start to converge. You can see some real wage growth for consumers, which would be really good for the economy because you're actually making more money in real terms than they were before, which we haven't seen in a while. So that could be really good for the economy. When we look at the labor market, it's really tough to get too negative because it's really tough to have a recession when we're creating jobs and at this record low level of employment. We don't see an imminent slowdown, right? So when we look at the data, kind of pointing to where the job market's going. On the left-hand side, we're looking at the ratio of job openings to job seekers, right? If there's plenty of jobs out there, if you want the job, you can get one. Now, I know there's some geographical concerns, may not be in the right place, and some technical things that, friction, you may not have the skills, but in general, if you want or need a job, there is one available and one available to you, and that shows on the left-hand side. And it has slowed a little bit, but still near record highs. And we're also get excited when we look on the right-hand side, look at the top right, look at the jobs quits, right? This is how many people are quitting their jobs. Well, you don't quit your job into a weak job market, or if you don't expect you're going to get a new job. You quit when you have a new job. I think you can get a new job. So again, that being near record level shows that the job market is strong and should maintain strong. On the bottom right-hand side, it's layoffs, right? And I'm sure we've all heard about them. Twitter's going to knock off 75% of its workforce. Meta's laying off something. A tech company down the street's laying off something. That's a lot of press, but it doesn't mean they actually do it. And when we look at the economy in aggregate at a whole, and we see the amount of layoffs actually happening in the economy, we can see, again, a little bit of a rise, but there's still almost at record lows. So taking the data in aggregate and the weight of the evidence from the labor market, it's really tough to make a case for a recession here. In fact, this is showing a very strong economy. and expected to continue and act as a positive influence on the economic environment. Also, a big player in the economy is housing, right? Generates a lot of economic activity, has a lot of impact on consumer sentiment. And what we're looking at here, not as bad as reported or feels. This is not '08 again. '08 was a credit problem. We don't have a credit problem. We have an interest rate problem. And a lot of the negative sentiment is around those mortgage rates. And you can see that right here, this chart going back to 2014, is that we've had an immense, almost a doubling of mortgage rates in the marketplace. That has to have an effect on investor sentiment and also has to have an effect on the housing market. And we're seeing that, right? So we see on the bottom chart, Case-Shiller housing prices, they're not going up as fast, right? They seem to be plateauing. What gets us more positive is we're still, even with that, we're still seeing housing starts out there. And why? Because to me, when we look at the mortgage market and the housing market, the most important thing is supply demand. And that's that top chart. That is the amount of homes on the market. So how many homes are out there and how many homes do we need? And you can see the long-term average is 3.9. We're at 3.2. So what does that tell you? Is that the housing market is undersupplied, right? There's not enough houses out there yet, and we need to increase our stock. So that gets us a little bit more positive on the housing market. And again, not saying we're bullish, outright bullish on this, and we would expect the housing market to cool somewhat, but given that underlying supply demand, given what we're seeing in prices, given what we're seeing in housing starts, it provides evidence for a slowdown and not an outright contraction in activity. And we can handle a slowdown given the other strengths we see in the economy. And we do think the consumer can handle this because the consumer is in a very good position. And what we're looking at now is, the consumer from a few different lenses, and they're so important. They make up 70% of the economic activity as measured by GDP. And you can see sentiment, how consumers feel. It's a survey, how they feel about the economy in the top chart. And it's indeed, it is at low levels, but you're seeing a bounce, up there. And it looks like it's headed in the right direction. And we're seeing it in their activity because they're not reducing their purchases, which can be seen in the real sales number in the middle pane, right? So again, we see a flat line, but not an outright crash like we saw in COVID. So again, feeling better, not great, but getting better. We were talking about expectations a lot and still having strong economic activity. To me, that uptick in sentiment can really be explained by that bottom chart here. And this is the price of an average gallon of gas, retail gas price, which is like 3.9. And you see just recently, it's up over 4.5%. I know I became a little bit more confident. I just filled my tank on my way to work today, for under $50 for the first time in a while. So really don't discount the effect of lower gas prices on consumer activity, as we anchor our inflation expectations to this number, right? Because it's something we see every day. It's an easy compare. We filled up a tank this week, we filled up a tank last week. Last week it was 70, this week it's 60, and that number doesn't matter, just knows things are getting cheaper, and we kind of feel that. It's an easy compare in the mind because our mind likes to take shortcuts. It's an easy compare, unlike food shrinkage, right? You're getting 20 Oreos instead of 25 Oreos. So, chicken went up by a couple cents a pound, but you bought a different size chicken, so you couldn't compare prices. And don't even get me started on trying to compare healthcare prices and auto prices. So again, don't discount that effect of the gas price on consumer sentiment and how that translates into economic activity. So, looking at the consumers, we also want to look at their balance sheet, right? So we know the sentiment, how they're feeling. We see the gas prices affecting that. But we look at the consumer balance sheet on the left-hand side. In aggregate, I know everybody has an individual story about someone who may be struggling and everything like that. But when you take the economy as a whole, the consumers are in a pretty good place. But to me, the number that's most important, and we watch very closely here at Stonehearth, is that top right-hand chart. And what we call that's the debt burden, right? They call it the household to debt service ratio, but it's how much of your disposable income is going to pay off your debts. And we like to look at this number because history shows as long as we can pay our current bills, we being consumers, we consumers will continue to spend. And when you look at the upper right-hand chart, you can see that 9.5% debt is still manageable, right? Back in the 80s, or at 10, that was manageable. You can see in the 07, that little crisis, that was up at 13%. So if we start seeing debt burdens increasing into those double figures, we might get a little bit more nervous. But what the data is telling us is that at least given the current scenarios, the current debt burden is very manageable for consumers. And we know throughout history that if they can manage their debt load, they will continue to spend, and that increases economic activity. So we've just spent a whole lot of time talking about the economy, inflation, and the Fed. Because that's what's currently driving markets. We're all macro tourists now. Everything's about macro. And I think it will continue to do so in the near future because it has such a great impact on the markets. But it won't always be the case. And over the longer term, fundamentals will drive the longer term performance eventually. So, let's take a look at the current fundamentals, and we'll start the U.S. equity market and see what's going on there. First glance, we're looking at the forward PE ratio. So it's just taking the current price of the index and then calculating the earnings for the denominator. And basically what it's telling you is how much you're paying for $1 of earnings. We can compare this to history and identify other markets cheap or expensive compared to history. And you can see we throw in the dotted lines of standard deviations. When you get outside those standard deviations, you can say you're in those tails, right? Those are those extreme situations, which we're in 2020. You can see that at 22 times, it was really up there. You can see now, given the performance we've seen so far in 2022, the recent slide in prices is helping. Not cheap, extremely cheap like we've seen before, like at the bottom of the great financial crisis. I'm not saying we're going to get there, but just not there yet, right? So it's getting cheaper, but not extremely cheap. You can see right here, it's currently at 15.15. And look at some other factors that we look at. Shiller's PE, it's the same thing as the forward PE, but just takes historical 10 years of earnings data rather than forward data. Kind of factors out inflation and gives you a number. You can see that it's near its average, a little bit cheaper. Dividend yield, a little bit less than its average, but right around average. Price to book, a little bit over. Price to cash flow, you get the general picture here. We're right around averages on most of this data. So again, the recent sell-off has helped. We are getting cheaper. We're just not extremely cheap yet at the index level. But there are pockets of opportunity out there in the equity markets. Again, not all equity markets are created equal. If you move away from this passive market cap weighted indices, and you can see in the next chart where you can see some actual decent valuation support. And this chart is very easy to read. On the left-hand side, you got the asset class. Mid cap 400 is small cap. It's mid cap, sorry, by definition. Small cap 600 small cap. I don't need to read them for you. Down below, the countries on the overseas. Green means it's cheap compared to itself or the S&P 500 throughout history, where it stands right now. Red's expensive. And you can see there are pockets. You can see in value, it's looking a little bit attractive from a fundamental perspective. Small cap looks attractive. Overseas does as well. I'm not denying that, but sometimes assets are cheap for a good reason. And we've talked about everything going on over in Europe, and there's probably going to be a good opportunity there because it can only get so cheap. We just don't see it there. And what we're really waiting for is seeing some improvements on some of those factors we talked about the war, the energy crisis, and some of the political turmoil over there. But again, moving away from the indices, moving away from the S&P 500, you can get some pocket of good, strong fundamental valuation support, and we're seeing that in the small cap space and in the value space. So that's kind of looking at the equity market. Now we're going to turn to the other major financial market, the fixed income market. And what we're going to look at is that yield curve. And we've talked about this a little bit on a few different charts. And you can see the different dates, 1 month, 3 months, 6 months, going out 30 years. That's just the length of the bond. So think about it as the length of a loan, and a bond is just a loan. So you can think about it that way. And this is what, at each point in time, the U.S. Treasury has to pay to borrow. And now, put it all together, you get the Treasury curve. And the current one you can see is on that salmon covered line up top. And so no surprise, we've seen that Fed relentlessly raise the Fed funds rate to curb inflation. We're seeing the entire curve rise along with it, because you can see where we started the year in that aqua green, and just that massive move upwards. We've never seen before, which we saw in the performance of the historical 60/40 portfolio in the Bloomberg aggregate index. Like we saw at the beginning of this presentation. What we're also seeing here, we get clues about the environment from the shape of the curve. And you probably hear a lot about, is the curve steepening? Is it flattening? Then a whole long 10-page dissertation on why that matters. Well, they just like to sound smart. What it means is flattening curve just means shorter term rates are rising faster or rising less than the longer term rates. So shorter term rates go up, longer term rates go down. And why do they do that? It's basically indicating a recession may be in the cards. Why? Because think about it. So what it's telling you is that the Fed's raising rates, right? So that's why the short end's going up, is the Fed can control the short end. But what the investors think is that the Fed's going to raise too much, and then at some point they're going to have to lower rates again. And if it's within that 30 years, you can see that inversion of the yield curve, or you see it flattening. So anytime you hear about flattening, all that means is that there's a risk or a greater risk of a recession, at least from an investor standpoint. So what the yield curve is telling us is that rates have risen tremendously higher, and that there is a greater chance of recession based on investor expectations because the yield curve is flattening. It's a little bit more flatter than it has been in the past. But it's not all bad in fixed income land. The recent rate rise is not all bad for investors. As a byproduct of the rate rise is, a more potential attractive income stream from fixed income, which we haven't seen in a long, long time. And what we're looking here is different parts of the fixed income market, going from pretty much less risky to more risky, but you have U.S. Treasuries, muni bonds, investment grade corporates, and the purple line is the past 10-year average of where rates have been. So the way to read the U.S. Treasuries is that over the 10 years, the average income stream from Treasuries have been 1.4. Not a great, right? When inflation is running at 8% or even above 2%, not a great return. Not a great investment thing. There's still some other benefits to invest in fixed income, like slowing down volatility, but in general, that income stream doesn't appear that attractive, not a reason to go into fixed income. But now we kind of look where we are, and where we are is in blue. So you can see at U.S. Treasuries, up over 4%. Even more attractive when you start getting out to like high yield, historically, it's been at 6% over the past 10 years. It's almost at 9.7. So what does this tell you? It says you might actually start getting a real return. That's after inflation income, an income stream above inflation from bonds, which would be a very nice treat for investors and savers. We haven't seen that recently. So again, there is some benefits to this rate rise, and some pieces of the fixed income market with that 9.7% return or 4.8% yield may start being attractive given our expectations for inflation may be slowing here a little bit, and definitely would be very attractive if we head into a recession. So again, there are some pockets of opportunity amongst the asset classes. So we've looked at the economic environment, we've looked at the equity markets, we've looked at the fixed income markets. So now what we want to do is put all this data together, and really look at it through our multiple lens risk model, which uses a weight of the evidence approach to judge the level of risk in the financial markets. And this really does help drive our asset allocation decisions. We use two models to help us understand the current risk environment and help asset allocation. And the first one we're looking at here is an external model from the folks at Ned Davis Research, which can be seen in this chart here. You can see that from the bottom column on the left that he's mostly bearish from his 4 indicators. And again, those are just the 4 top line indicators. Underneath there, there's 29 different sub indicators, and under that 29 sub indicators, there's over 39 different indicators. So again, a lot of data baked into this model, presented at a really high level. So just when you look at this chart, it looks like a few lines and 4 indicators, but there's really a lot of depth and breadth to the information going into this model. And you can see that 3 out of the 4 indicators are negative in a bearish territory. You can overall level of his risk model is negative at a -3. The one bullish piece is sentiment. That's a contra-indicator, or what we call a contra-indicator. And what it means is it's so bad it has to be good. And what his indicator is designed to measure is that if sentiment gets so negative, it has to reverse, and that's bullish for the model. But again, that does not outweigh the negative they're seeing in the tape. That's technicals, monetary, just the monetary environment, and combo, which is overseas markets. So to complement this, we also use our own internal model to complement NDR, which hopefully you've seen this before. We use 4 lenses to view the market risk. The first one's technical, broken down into 2. Reversion, which is kind of looking for exit and entry levels, and structure. How is the market performing? What's performing well, what's not performing well. We also look at it from a valuation picture, because we do know that valuation drives longer term returns. And we look at different things like the CAPE, which we saw in the previous chart. We look at slope of earnings and kind of dividend yield. We also look at the macro environment, which we saw earlier in this presentation, and there's a qualitative piece, because again, some factors just cannot be captured by a quantitative model. So when we take a look at our model, we look at the number right here. This is the sum of the model. We met last quarter at a -6. Not a big change from last quarter, a -7 compared to that -6. And really more noise than signal. And our model really continues, no changing from last quarter, to point to a negative environment for taking excess risk. And we kind of break it down into different components. We look at that technical, and you can see the structure was neutral last quarter, and now it's a -2. So again, that really just driving that drop in the technical picture. And you can see from the top ones, we look over here, you can kind of see really what's driving that reversion of the structure. And you can see, cyclical staples, sentiment, do negative. That was a small improvement. So again, above 200-day to negative. So you can see that the decline is really driven by the breadth and sentiment decline that we're seeing. Overall, the technical picture dropped by 1, as that drop we saw in the structure was offset by a slight rise in that reversion indicator, which is really driven by the VIX, which is basically the fear indicator, one of our more contra indicators. So overall, technical picture still not supportive of taking excess risk in portfolios. Looking at the valuation, no change. The valuation indicator, even with this large sell-off, it's just not enough to work off the excesses that have been built up into the markets over the past 12 years or so. So again, no improvement on the valuation front, and still negative for taking on risk. And as we saw earlier in the presentation, the macro data is a lone bright spot in an otherwise, very dreary risk picture. And while positive, it does not offset all that other negative we're seeing. The weight of the evidence still points to negativity in the marketplaces. Those other areas of the market are overriding that economic data. Stonehearth IC committee also has a negative outlook. No surprise. Given with the Fed intentions and some divergences between what the Fed thinks is going to do and what investors think the Fed's going to do, we just think it's not a really conducive environment for taking on excess risk right now. So when we look at the two models together as they complement each other, what we like to say here at Stonehearth, our two models are in harmony. They're telling us the same story. And that gets a little bit more confident in our understanding of, are they telling us the correct story or not? So the overall weight of the evidence of our risk modeling is indicating a cautious stance in asset allocation. That's poor technical picture, elevated valuations, hawkish Fed outweighs the positive influence of the macro environment. So let's take a look, so now we know what our risk models are telling us. So let's see how the weight of the evidence translates to our portfolio allocations. Look here, we remain defensive in our asset allocation, but we're not 100% bearish. We intend to remain patient, really given the current defensive positioning we have already and the really muted evidence available. So we're really waiting for stronger signals to emerge before acting. We can see over here the risk assets, as we define by equities in the United States, international, developed, and emerging markets in red, remain underweight risk assets. But we do favor, and within the equity space, the US over international, like we saw, we do favor small over large, and we're leaning towards more traditional value stocks and stocks with some positive momentum features when you're investing in that space. You can see the next line, we maintained our overweight to fixed income, but remain underweight traditional fixed income. We find there's better options out there. We're overweight really coming from our bond substitutes, our flexible income products that can manage duration and are better positioned to weather an uptick in interest rates. And we're seeing that in performance in the portfolios. Remain overweight to cash, should be no surprise given the risk modeling we just saw. And look at the opportunistic bucket where we see dislocations in the market to take advantage of. We still maintain our underweight. Opportunistic bucket. We're waiting for better opportunities and just haven't seen those yet. So taking everything together, kind of summing up everything we've talked about today, and our final thoughts before we answer questions, performance. It really was nowhere to run, nowhere to hide over the past quarter or the past year. Little spots, but nothing major. Data history. Fed has more work to do, right? Further rate hikes are coming, but maybe not as many as investors think. Inflation, starting to see some improvement. But like we like to say around here at Stonehearth, lower inflation does not mean low inflation. And the data is pointing to potential elevated inflation compared to history, but still lower from where we are. As 4%, maybe the new normal. And 4% is not bad given what you're seeing in the fixed income market and what you're seeing for expectations. Definitely slowing economic growth for sure, but no contraction in economic activity that matters. So again, those data that looks to understand what's happening in the economy in the future, not looking backwards. Valuations improving given the recent sell-off, but not cheap by any metric yet. But there are pockets of opportunity if you know where to look. We always like to say here at Stonehearth, it's where you take the risk that matters, and make sure you're taking it with risk where you have valuation support. Rising rates, there is a benefit, right? There's a flip side, economic data. I was talking about that right-hand sides of the coin, and bonds becoming a little bit more attractive, giving that high yield. But overall, when we look at everything, it still remains negative out there, with more noise than signal right now. And really, we're waiting for a stronger signal. So it's really pointing to an excess risk in financial markets, and caution really is warranted in portfolios. And so with that, you read my compliance documentation, compliance disclosures, real quick, take a snapshot of it. Got it? Just kidding. But again, we have to do the compliance disclosures. And now I'm going to turn it back to Amanda and see if you have any questions.
Hi, Chris. Thanks so much. Just as a reminder to everybody, there is a question section of your GoToMeeting taskbar, so you can enter some of your questions there, but we will get started with the ones that were submitted already. Chris, why would I invest in bonds with a yield of, say, 4 to 7% when inflation is running above 8%?
Good question. Yeah, at first blush, it doesn't seem the right way, right? Inflation's up at 8, yields at 4. Why are they attractive? And really, to me, it comes down to the investment horizon or length of time you own the bonds, right? Inflation is a point in time, while that yield number we're looking at is an aggregate number and based on your holding period. So for what we're looking at before, think about it this way. That 8% or 8.3% is the CPI growth rate over the past year right now. While that 6% yield is what you receive every year for the next 5 years, depending on the maturity schedule of the bond. So if that 8% inflation goes down to 4%, goes down to 5%, goes down quicker, then that average inflation is not 8% over the life of the bond. It's a little bit lower. So if inflation expectations 5 years out by investors are about 3%, so if inflation falls and the average of the next 5 years is 3% inflation, where investor expectations are, you earn a real carry. So not bad in this environment for the amount of risk taking. So it's really all about the length of time and where the inflation rate is going to be over an average over the next 5 years, not a point in time, which makes fixed income a little bit more attractive.
Thanks, Chris. The next question we have here is that you had mentioned that the economic data is pointing to a slowdown, not a recession, but aren't we already in a recession? Can you explain?
Sure. So I'm assuming that question is due to the recession calls by NBER and the 2 quarters of negative data print we had in 2024. NBER does have the final say, right? But they have not yet formally declared a recession. I know it feels like it, since many people have been talking about it, and you had that 2 successive quarters of negative GDP growth, which kind of funny used to be the definition of a recession. But not now, right? The official definition from the horse's mouth, which is directly from, what NBR says, is that it's a significant decline in economic activity that is spread across the economy and that lasts a few months. It uses multiple data points in deciding it. But to me, it really doesn't matter what NBR decides, and it's always backward looking, and they always tell us after a recession ended that we're in a recession. So that's not really a lot of help when investing portfolios. So you can see why economists can drive people crazy. To us here at Stonehearth, it's really more about using the weight of the evidence and identifying where the economy is more likely headed. Is it expanding or contracting in the future? And comparing that to expectations. So now we see the data points of an expanding economy against a backdrop of increasing recession expectations, which, while being a positive influence on the risk environment, is really not enough to offset that negative influence of other factors. So no recession yet. In our mind, the data is not telling us that. We can wait for NBR to do it, but stay tuned for the data that actually matters and look at the data that's telling you about where the economy is going, not where it's been. So I hope that helps understand kind of how we frame that recessionary talk.
And Chris, I think this next question here, I know just from experience with clients that a lot of clients of ours have this question. I look at the recent negative returns in the market and wonder why I'm even invested. Doesn't cash make sense? Even with defensive positioning, you still had negative performance.
True. Again, you're thinking about a poker hand, you can only really play the hand you're dealt, and we really weren't dealt a good hand in the markets. And as I've shown, it's not all negative out there in terms of economic. The data we're seeing, there are some bright spots. Cash is tough. and it earns little to nothing. Even with the recent rate rise, doesn't earn that much. And while sitting in cash, you can miss out on some really good, strong rallies, like we're seeing right now, right? Recently, we're up almost 7% in the S&P this month. Doesn't feel like it, but the S&P is up a little over 7%. You know, the real purpose of our risk modeling, portfolio construction, is not to never lose money, and excuse me for the double negative there, you know, but it's the only fund that has done this, was never to lose money. It was run by Bernie Madoff, and you know how that turned out. You know, what we're really attempting to do is to limit some of that downside, protect, right? Protect and preserve the hard-earned capital you've earned, so our clients get to keep more of what they earned in their portfolio, which then get the benefit and the joys of compounding when better days arrive. And one thing is for sure, they will arrive. It's very tough to accomplish that sitting in cash. So again, cash is a useful tool. It's a piece of portfolio allocation. For the 100% cash call, you have to get it right going in, going out, and you can miss out on some really strong returns in the meantime. So the best I can do is explain that, but just trying to minimize those drawdowns to protect and preserve what you have so you can grow when better days arrive. So I hope that helps. And if anybody wants to talk more about that on a more individual basis and a portfolio level, please give the office a call, and I'm happy to jump on a phone call with anybody to talk about the individual portfolio performance.
So thank you so much. I think that's actually it for today, and just being mindful of the time. I just want to start wrapping things up. I just want to thank everybody for joining us for CIO's Corner for this quarter. That kind of wraps it up for the calendar year. So we'll be getting together, Chris and I, and going over the webinars for next year, and those will be posted on the website by year end. So keep a lookout for those. We'll be hosting to discuss Q4 in January, so likely the end of January. And of course, we'll keep you all informed through email. And again, like Chris said, if you have any questions, please don't hesitate to give us a call. It's 978-624-3000. You can also find all of our information on our website, www.stonehearthcapital.com. And Chris, thanks so much for speaking with us today.
You're welcome. Have a great rest of the year, everybody, and we'll talk to you in the new year.
Yeah, Happy New Year. All right. Thank you.